In Europe, the European Central Bank left its policy unchanged, but carefully refined its communication. So the ECB acknowledged both upside and downside risks to growth and inflation. The Eurozone economy expanded by 0.2% in the third quarter, helped by stronger than expected growth in France. This is where GDP rose 0.5%. These modest improvements suggest that the Eurozone remains on a fragile but stable path to recovery. Oil prices rose slightly during Asian trading hours on Monday. This followed OPEC's decision to slightly increase production in December and postpone further increases in the first quarter of 2026, a move signaling caution amid demand uncertainty. At the meeting, the 8 OPEC members agreed to increase production by 137,000 barrels a day in December 2025, which is the same as in October and November. The key point is that the organisation announced a halt to further production increases in the first quarter of 2026, citing seasonal factors and demand weakness. The decision was met with complex signals, and both the bulls and the bears interpreted it differently. The bulls believe that a halt in production increases limited new supply in the market, providing support for prices. The bears, on the other hand, believe that the moderate production increases in December and the halt in early 2026 implied OPEC's concerns about weak demand, especially in Asia. External supply risks have also exacerbated the complexity of the situation. Stricter US sanctions against Russian oil producers have created uncertainty regarding export flows. Meanwhile, strong production from non-OPEC countries coupled with rising demand has limited upside potential for oil prices. Last week, gold faced multiple headwinds, but the market showed resilience. From the trade agreement to Federal Reserve Chairman Powell's hawkish stance, it was a double whammy for gold, yet prices still stabilised at the $4,000 mark. Despite 2 consecutive weeks of declines, we believe shorting gold at this time is not a wise choice, especially considering all the seasonal factors that gold has ahead of it. Gold's strong seasonal support, with November through to January being the peak traditional season. Although it has already risen 50% this year, gold's seasonal upward trend has been effective for the last 10 to 15 years. Investors are expecting a sharp drop in gold prices and they may be disappointed. Everyone had hoped to buy gold at around the low of 3,500. However, despite the fundamental easing of trade relations, current buying momentum in the international spot market is insufficient. It is consistently believed that every easing of trade tensions foreshadows renewed tensions months later. So when conflicts escalate again, gold will face new upward momentum.